We have Sanjay Parekh joining us from Soham Asset Managers to talk to us about just that. Sanjay, hi, thanks so much for making time. What's your sense on
Right.
the market? Because the last couple of months have been extremely painful, at least at the portfolio level. Do you think the bulk of the pain is out of the system and one should start actively buying now?
Yeah, so one is, I think on the price front, I'll just give you a background, the way we think about it, that all the balance sheets are in a very good shape, um, at the starting point. So the household balance sheet, at least at the top end and the higher middle class, is in good shape. Of course, we have issues at the lower end. The corporate balance sheet is fine. And the banking balance sheets also, we've seen some leg up in credit cost, but nothing to worry. And then, RBI also has space to expand its balance sheet. We've seen that recently. If required, they can, provide liquidity and expand its balance sheet. Government also fisc, we will see it a roadmap towards reducing fiscal deficit. That is very clear. So, and balance of payment situation, barring the recent FII selling, which has caused some pressure on rupee. I mean, if there is no big yuan depreciation, I think, you can never say never because dollar index is tough to predict. But I think we should be in a reasonable zone. So with all of it, structurally, we are in a very, very good shape. In the near term, we had Q1 and Q2 earnings, which had slowed down. Q3 also, we will have lower earnings growth. So that's where you see markets being reacting. And as we see slow earnings recovery, which we expect, then I think we should be done. So what we think is the price-wise, we are largely done. I mean, you can never say never, but we really feel from here, at least at the Nifty, we are done. Time-wise, as the earnings recover slowly, we will see an appreciation.
So price-wise correction may be over, but time-wise correction could be in the store. But Sanjay, also help us understand that which are the sectors that looked attractive to you at this price point? Because in terms of the earnings, there hasn't been major disappointments till date coming in, and majority of the companies, if I say, either they have tried to meet the expectations or they are above the expectations. Some bit of a disappointment definitely in store. But which sectors are looking good to you where one can start accumulating?
So, as you can see in our portfolio, we are equal weight on autos. We are overweight on financials, banking and financials both. We are mild overweight. Overall financials, we are overweight. Capital goods, we are mild overweight. Telecom, we are overweight. Logistics, we are overweight. Pharma, we are mild overweight. We are underweight significantly in FMCG. We've got underweight on IT as well, which has, of course, hit us in the last 3 months. But by and large, the strategy has helped us over the last 2.5 years. And our positioning is always that at least 70% would be large cap. In fact, right now, our average large cap holding is 73%. So it's worked broadly. And this is our view right now on our sectors.
I know, Sanjay, that you've always been a big proponent of, GARP investing, but do you think it's time now to shift from momentum to value?
So, when we say GARP over all my career, what we said is we'll buy growth, we'll love growth, but we'll buy at reasonable price. So our portfolio price earning today, I was just saying we're at 14 times now, which was more like 15 times December end. But more so the growth in our portfolio will be more like 18 or more like 20%. ROEs will be higher, which is better than Nifty. So we want to buy growth at a reasonable price, and that's our style. So we will not overpay for growth, and at times you miss out on, some of the very high price earning stocks which are perceived to have high growth. But you've seen that volatility also. Some of them moved up so sharply, and the falls were equally sharp. So we're consistent to our strategy of growth at reasonable price, and it's worked for us broadly.
If I can just ask you a follow-up there, I mean, I'm just taking example of a few stocks which are those ideal candidates of, growth at a reasonable price. I mean,
trend, some of the EMS companies were not in that zone. They were giving growth but not at reasonable price. Do you think they're getting into the reasonable zone now? Even Zomato and the other new age platform companies?
Yeah, so ma'am, I just said at times a strategy like this on the rise, we missed out on a lot of them. So Sigma we did buy at 280 rupees, but we sold it way early at 370 very soon. Immediately, we picked up very early. We're tracking all of them, the EMS space, but we still feel that as they get their scale, market is really pricing it far ahead of times. And hence we are in a zone where we still want to watch them and enter at the right price. As I said, Zomato on the rise also we didn't participate. On the fall also we didn't participate because we genuinely feel that these are high growth companies, but to get a meaningful size and to justify the current market cap, at least we're not comfortable. Trend has done exceptionally well, but we missed out again because of the style that we have. But it's been a great, great performer. Hats off to them. So that's how we are. And in terms of our, our portfolio, we think financials, because the sanctity of the book value, now profits are real. So on a price earning or price to book, they look very, very reasonable for the ROE and growth. Some of the auto companies, while they're near-term earnings issues, but they look quite reasonable, be it Maruti or Mahindra. And even in logistics, we think things look reasonable now. Also, in capital goods also things are fine, reasonable. So across now in Nifty, you are getting a lot of opportunities. It's the best thing, So we would have at any point 16 to 20 names in Nifty in our overall portfolio of 33 to 35 names. And now we see a lot of value in Nifty, and that's what is making us feel now that now it's quite reasonable. If you take earnings of 1,200 rupees for next year and then 1,350 for 26, 27, if we take 20 times broadly, India should get. That's been the range of last 5 years. That takes us to 27,000. So on 25, 26, of course, we are not that cheap. We are 19 times. So we think that we could see a time correction from here. And these earnings are reasonable. So I don't expect further downgrades from this levels where this year, 24, 25 will end at 6, 7% growth. And then more like 10 to 12%.
All right, but Sanjay, since you highlight that maybe part of the correction could be over when it comes to the Nifty 50, the large cap is the safe place to be in. Just wanted to get a sense that in the recent fall, have you also deployed any fresh capital as per se? I just wanted to get a sense that what is the sentiment on the street with respect to the fund managers as per se, that are you guys also deploying any fresh capital to get benefit out of the reasonable valuations, or you are waiting for some more correction and then maybe deploy afresh?
Yeah, no, very relevant question. So, we are an AIF and PMS, so we cater to HNI family offices. They've been very mature. Of course, nobody likes when there's erosion in market values. But by and large, they've been very, very mature, guided by the distributors. In fact, almost all the queries are, should we deploy now? What should be the pace of deployment? There's no panic. Absolutely very, very mature way of thinking. And that's where we've also told them as well that you can definitely now invest and slowly and gradually deploy. So our strategy is also aligned where as we get flows, we are slowly and steadily, because you're getting a lot of opportunities. This volatility is throwing really a lot of opportunities. So you have to pick and choose which one will give you not only less downside, but for the growth you're buying at a very reasonable price. And that's where we are picking and choosing based on our portfolio construction, be it financials, be it auto, as I said, logistics, telecom, retail, across within our spectrum of portfolios, within our existing stocks or even new holdings. We added recently HDFC Life. We also added small way DLF. So when stocks are getting reasonable, we are adding some of them, and that's our strategy. But we still have 5-6% cash because we're getting inflows, and we will gradually deploy that over the next 2-3 months.
Looking at gradually deploying, but the volatility is clearly throwing a lot of options and opportunities. Thanks, Sanjay, for making time and speaking with us.
If you like this video, then like, share and subscribe to ET Now.